Wall Street continues its close observation of the Chinese economy, and recent economic data from Beijing has presented a nuanced picture for global markets. While there has been a notable surge in consumer spending, the manufacturing sector, a traditional pillar of the economy, has experienced a slowdown. This contrast reveals a tale of two economies within China, one driven by domestic consumption and the other grappling with external pressures. Understanding these diverging trends is crucial for global financial perspectives. Let's delve deeper into the specific figures that define China's current economic landscape. China's retail sales in May showed an impressive annual increase of 6.4%. This figure marks the fastest growth rate observed since December 2023. The performance significantly surpassed analysts' expectations, which had predicted a 4.9% increase in a Bloomberg poll and a 5% rise in a Reuters poll. This acceleration was also notable compared to the 5.1% growth recorded in April. Several factors contributed to this unexpected surge in household spending. A primary driver has been the government's aggressive trade-in subsidies. These programs actively encourage consumers to replace older household appliances and automobiles with new ones, directly stimulating retail activity. Data from the Ministry of Commerce indicates that these trade-in initiatives alone generated approximately 1.1 trillion yuan, around US $153 billion in sales this year as of May 31. The early commencement of China's massive 618 online shopping festival also played a significant role. This major e-commerce event, celebrated to mark JD.com's founding on June 18, 1998, offered substantial discounts that spurred consumer spending. An addition to foreign tourism, facilitated by the expansion of the country's visa-free entry list, further supported the rise in household expenditures. Ling Huifu, a spokesperson for the National Bureau of Statistics, NBS, directly attributed the improved consumption in May to these factors, including the trade-in program, the surge in online shopping before 618, and the rise in foreign tourists. Ziwei Zhang, president and chief economist at Pinpoint Asset Management, also highlighted the potential impact of the government's trade-in program. Zha Yuhan, principal economist at the Conference Board's China Center, noted that the retail data appeared to be strong, particularly in dining and home appliances, driven by holiday effects and consumption-promoting policies. This increase in consumption in May offers a welcome reprieve for the world's second-largest economy, which has been contending with persistent deflation. Lin Song, chief economist for Greater China at ING, characterized the retail sales figures as an encouraging sign of recovery. However, China's factory output presents a contrasting narrative. Industrial production growth in May slowed to just 5.8%. This marks the slowest pace recorded since November of the previous year. The figure also fell short of expectations, as a Bloomberg survey had predicted 6.0% and Reuters had forecast 5.9%. This slowdown is evident when compared to April's 6.1% growth and March's more robust 7.7% increase. The deceleration in manufacturing is a direct consequence of the ongoing trade tensions with the United States. Zichun Huang, a China economist at Capital Economics, specifically pointed to weaker external demand as a significant contributing factor. Despite a temporary truce reached this month between the U.S. and China, which had seen tariffs escalate to eye-watering levels, the impact of the trade dispute was clearly underscored by these official figures. Exports to the United States experienced a sharp decline of over 34%, or 35% according to some reports, in May compared to the previous year. This represents the steepest drop recorded since February 2020. This significant decrease occurred even though Beijing and Washington held talks in London last week aimed at reaching an agreement. Commerce Secretary Howard Lutnick affirmed last week that U.S. tariffs on Chinese imports will remain at their current level of 55%. While some businesses attempted to front-load shipments before tariff increases and exports to other regions like Southeast Asia, European Union, and Africa showed some resilience, overall export growth in May was still a modest 4.8%. This was considerably lower than economists' forecasts and a sharp drop from the 8.1% growth observed in April. Despite this, Goldman Sachs noted the overall resilience in exports, suggesting that bilateral tariffs have found it difficult to meaningfully reduce total Chinese exports. However, Zichun Huang of Capital Economics warned that with tariffs set to stay elevated and exporters facing broader constraints, points, export growth is likely to slow further by year-end. Adding to the complexity, the country's property market continues to be mired in a deep slump. Real estate investment declined by more than 10.7% year-on-year in the first 5 months of the year. Housing prices in most major cities continued their monthly decline in May. Specifically, new home prices in wealthier Tier 1 cities fell by 1.7% year-on-year, while Tier 2 and Tier 3 cities experienced drops of 3.5% and 4.9% respectively. This ongoing weakness in a crucial sector is a major concern as it directly impacts consumer confidence. As Lin Song of ING noted, a more sustainable consumption recovery will likely depend on a significant turnaround in this confidence, which remains much closer to historical lows than averages. An NBS official acknowledged the need for more efforts to halt the downturn in the real estate market. Given that the property sector is a vital repository of wealth for most families, its struggles contribute to increased consumer caution. Deflation remains a persistent challenge. Consumer prices have fallen for 4 consecutive months, decreasing by 0.1% year-on-year in May and by 0.2% month-on-month. This marks the longest period of falling prices in over a year. Factory gate or producer prices were also deeply negative, falling 3.3% from a year ago, reflecting weak demand across the economy. This sluggish domestic demand has been an urgent issue for Chinese policymakers. On a slightly brighter note for the labor market, the urban surveyed unemployment rate showed a slight improvement, easing to 5% in May, which represents the lowest level since November of last year. Beijing has set an economic growth target of approximately 5% for this year. The recent stronger-than-expected retail sales figures may potentially reduce the immediate pressure for new aggressive stimulus measures. The National Bureau of Statistics stated that the economy maintained stability last month as authorities stepped up the implementation of more proactive and effective macro policies. However, economists caution that this consumption rebound might be short-lived without robust policy support. Tianchen Xu, senior economist at Economist Intelligence, anticipates that private consumption could face a triple whammy if policies are not sustained, including the conclusion of the front-loaded 618 festival and the potential suspension of government consumer subsidies. Indeed, local governments in several cities have recently paused their consumer goods trade-in programs because the initial central government subsidies have been depleted, with additional funding yet to arrive. Further significant stimulus is likely being held in reserve and may only be deployed if economic growth falters to below 4.5%. The government recognizes the presence of numerous unstable external factors and continues to aim for strengthening domestic demand. Janwei Xu, senior economist at Natixis, echoed this sentiment, stating, "Absent further demand-side stimulus, we expect that the consumption recovery will be short-lived." Another key indicator, fixed asset investment, expanded by 3.7% this year as of May, which was below expectations and slower than previous months, highlighting other areas that require attention. We will continue to monitor these dynamics closely. Understanding the intricacies of China's internal economy amidst global trade shifts remains paramount for investors and businesses worldwide. Thank you for your time and attention to this important discussion.